Did you know that nationwide, the amount of office space deemed functionally obsolete is expected to reach 330 million square feet by 2030? This staggering statistic highlights a growing trend in commercial real estate, the conversion of empty office or retail buildings into much-needed housing. Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. As office vacancy rates remain high across the North Bay, property owners and developers face a pivotal decision: renovate aging commercial spaces to attract new tenants or convert these properties into residential units. This trend is evident in Santa Rosa, where plans are underway to transform 2 bank buildings into apartments. Similarly, around 24 projects in Marin County aim to convert commercial spaces into housing, reflecting a shift driven by high vacancy rates and changing market demands. However, converting office or retail spaces into housing isn't as simple as it may seem. According to experts, many buildings don't make sense for conversion from a physical standpoint. Wick Polite, principal at Seagate Properties, notes that unless buildings can be purchased essentially for land value and then redeveloped from scratch, the economics often don't work out. This is particularly true in Marin County, where property values can exceed $400 per square foot. The physical configuration of buildings is a primary consideration in conversion projects. Office buildings often have large open floor plates, which don't easily translate into residential layouts. Whitney Strotz from Cushman & Wakefield emphasizes the need for significant plumbing infrastructure and mechanical systems in residential conversions, which differ from office requirements. Despite these challenges, the post-COVID shift in office utilization has made conversions more financially viable, according to Lauren Brueggemann from Phoenix Development. The trend of converting commercial spaces to residential units is accelerating in Marin County, with roughly 20 projects in the pipeline. Hayden Ongaro from Newmark highlights that the current office environment, coupled with streamlined housing approvals, makes residential development the highest and best use for many properties. This shift is supported by the Marine Environmental Housing Collaborative, which advocates for redeveloping existing sites to prevent urban sprawl and preserve open spaces. In Kitchener, Waterloo, London, and Cambridge, Ontario, similar trends are being observed. High office vacancy rates are prompting developers to consider residential conversions, though the physical and economic challenges remain. In contrast, American cities with high vacancy rates like San Francisco are also exploring these opportunities, showcasing cross-border relevance in the commercial real estate landscape. Indian real estate developers are adapting to the aspirations of Generation Z, particularly in Tier 1 and Tier 111 cities. Fueled by infrastructure development and a skilled workforce, these regions are witnessing a surge in demand for modern amenities and tech-enabled workspaces. Developers are investing heavily to cater to this evolving market, anticipating significant growth in India's office sector. Real estate developers in India are rethinking their business strategy, keeping in mind the aspirations of the youth, especially the Generation Z segment. Regional commercial real estate players, particularly in Tier 1 and Tier 1-3 cities, are ramping up projects to meet that emerging demand, say executives. Luxury cafes, fine dining restaurants, gaming centers, salons, malls, and exhibition centers are booming in Tier 1 and Tier 1-3 cities with the growing demand for such amenities. Real estate players are cashing in on these opportunities. The commercial real estate sector is undergoing a generational transformation as the baton passes from baby boomers, Generation X, and millennials to the tech-savvy, environmentally conscious, and entrepreneurial Generation Z. The real estate players are closely monitoring the lifestyle of Generation Zs, the term coined for those individuals who were born between 1997 and 2012, as the demands of this generation are different from other generations. Adish Oswal, chairman and managing director of Oswal Group, noted that Generation Z culture is far more mature today. Thanks to the world of technology, the youth of Punjab, apart from good families, think that even in the middle-income group, the children are studying all across India and the world. They're coming back, and they have huge aspirations. His Vardhman Amrante Group recently announced it would invest 1,350 crores in Punjab's real estate, focusing on Ludhiana and other cities. The investment will be distributed across multiple real estate segments, including commercial, residential, hospitality, industrial, and other allied sectors. Observing the trends in non-metro cities, Santosh Agarwal, Executive Director and Chief Financial Officer at Alpha Corp, mentioned that Generation Z is reshaping the commercial real estate landscape, particularly in Tier YI and III cities like Amritsar, Karnal, and Meerut. These emerging hubs are benefiting from better infrastructure, enhanced connectivity, and a growing appetite for modern, tech-enabled workspaces. According to the India Brand Equity Foundation, the real estate sector shows promise with a projected 9.2% compound annual growth rate from 2023 to 2028. Srinivas Rao, Chief Executive Officer of Vestian, said that regional developers have ramped up activity in these emerging locations, delivering customized commercial assets that meet the evolving needs of the new workforce. Simultaneously, leading Grade A developers from Tier 1 cities have expanded into non-metros to tap into this growing demand and strengthen their presence in these high-potential markets. The demand for office space in Tier 1 and 1-in-1 and 1-in-1 cities is propelled by decentralized work models, infrastructure development, and the availability of a skilled workforce. Approximately 15% of India's tech talent currently resides in these smaller cities, highlighting their growing role in the talent landscape. Vimal Nadar, National Director and Head of Research at Colliers India, says that the growth of startups in Tier 1 and 1 cities has further boosted commercial real estate demand. Recognizing the inherent growth potential, leading real estate developers are increasingly venturing into Tier 1 and 1 and 1 and 1 and 1 cities, with high-quality offerings across asset classes, including commercial real estate. Nadar further added that these smaller cities are likely to become the next growth engines for India's office market and supplement the established Tier 1 markets. In an evolving retail landscape, Simon Property Group, a leading mall real estate investment trust, IREIT, continues to demonstrate resilience. The company holds a market capitalization of $51.17 billion and maintains a strong market position. According to Investing.com, Simon Property Group's overall financial health is rated as GOOD, reflecting its stability despite challenges like tariffs and changing consumer behaviors. Financially, Simon Property Group reported solid results for the first quarter of 2025. The company's funds from operations, or FFO, stood at $2.67 per share, surpassing analyst expectations. Additionally, pure real estate earnings were higher at $2.95 per share. This performance is reflected in a robust gross profit margin of 82.37% and annual revenue of $5.99 billion. Notably, Simon Property Group has maintained dividend payments for 32 consecutive years, showcasing its financial stability. Operationally, Simon Property Group's international platform has been a significant asset, allowing for diversified revenue streams. Consistent leasing demand underscores the enduring appeal of high-quality retail locations offered by the company. Retailers continue to seek space within Simon Property Group's properties to complement their online sales channels, driven by omni-channel strategies. The company benefits from a favorable supply-demand imbalance in the retail real estate sector, particularly with limited availability of Class A mall products. This positions Simon Property Group advantageously, maintaining strong occupancy rates and potentially negotiating favorable lease terms. The company's long-term strategy has led to its outperformance of both the broader REIT sector and the S&P 500 since its initial public offering over 30 years ago. However, challenges persist, such as the ongoing impact of tariffs on retailer inventory levels and sourcing strategies. Foreign tourism softening, especially in Canadian and Mexican border centers, could also affect foot traffic and sales in some properties. Despite these challenges, Simon Property Group's ability to attract and retain tenants suggests potential for continued growth and stability. The retail sector's evolution, with an emphasis on omni-channel strategies, has led to sustained demand for prime retail spaces, like those offered by Simon Property Group. The success in navigating these changes demonstrates the enduring value of well-located, high-quality retail properties in today's retail ecosystem. The Fair Oaks Ranch land development is back on track under a new name, Post Oaks Subdivision. For over a decade, a 345-acre development in Fair Oaks Ranch was stalled due to a land dispute. However, city officials have now resolved the issue and announced a date for a city council vote on the development agreement. The vote is expected to take place on May 20th, and if approved, the city will begin the annexation process and related zoning actions later this summer. Mayor Greg Maxton emphasized that the agreement represents years of persistence and thoughtful negotiation. He stated that the proposed development protects the city's rural character while allowing the property to be integrated into the community on terms favorable to Fair Oaks Ranch. After extensive negotiations, legal challenges, and community discussions, an agreement has been reached with the owner of the former reserve at Fair Oaks Ranch, now renamed Post Oak Subdivision. The new development proposal features a lower density plan that aligns with the city's values and vision for responsible growth. Located in the northern part of the city along Hamoen Road, the Post Oak subdivision is directly across from the Stone Creek Ranch subdivision. The city has been debating this subdivision since 2013, when a previous proposal included more than 600 residential units and a private wastewater treatment plant. The current proposal reduces the number of homes by nearly 60%, preserves 1-acre lot sizes, maintains the city's tree canopy, and incorporates a public improvement district to finance infrastructure without using city funds or affecting the city's credit rating. City Manager Scott Huizenga noted that this resolution grants local control over a critical area of land that would otherwise develop outside city oversight. It ensures transparency, aligns with infrastructure planning, and keeps the community informed throughout the process. An open house is scheduled for May 13th at Fair Oaks Ranch City Hall, where residents can gather information, view maps, and engage with city officials and the development team. This meeting is open to the public and aims to provide clarity on the development's timeline, public hearing dates, and frequently asked questions. Let's turn our attention to some exciting developments in the commercial real estate sector. On January 30th, the grand opening and ribbon-cutting ceremony for the Keller Williams Realty Leading Edge Commercial Division office took place at 2 Charles Street in Providence, Rhode Island. This new location is directed by Michael Alves, the Keller Williams New England Regional Commercial Director, and is owned and operated by broker John Sumick, operating principal Stephen Thibodeau, and team leader Kimberly Foley. Over the past 5 years, they've built a robust team of 15 commercial brokers in the state, alongside 80 commercial regional brokers. This achievement places them among the top 10 commercial firms in the United States, with an impressive 2,900 agents nationally. The event was generously sponsored by Brian McMahon, Vice President of Commercial Lending with Pawtucket Credit Union, and attorney Hong Tran of LaHong Attorneys at Law, LLC. Keller Williams Residential also shared remarkable news, having claimed the top spot as the #1 real estate franchise in the U.S., boasting the highest agent count globally. Their residential office in Lincoln, located at 14 Breakneck Hill Road, is celebrated as the #1 location in Rhode Island for residential sales. These achievements underscore Keller Williams' commitment to growth and excellence in the real estate sector, both commercially and residentially. It's exciting to see such dedication and success from a firm that continues to lead the industry both nationally and internationally. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.